Hello everyone. So guys, we are going and this chapter, this unit is known as risk management. Sorry, it's unit number 12 actually. Okay, so and this section is called risk management. So in risk management, please remember here, we have two topics. The first we have here introduction to the risk management, and in second 12.2, we have here COSO Enterprise Risk Management Framework. Actually, it is called ERM framework, Enterprise Risk Management. So please remember this one unit, which is risk management, this unit number 12, is going to be 10% of your exam. So almost you can say out of 100%, 10% exam will be tested from this unit. So it is a totally theoretical area, but it is really important from exam point of view. So what we are going to talk here, first we are going to start with the risk management 12.1, like what is the risk management. So guys, starting with the definition here. So what is risk first? Definition of risk. Actually, we can define the risk in different ways. The first way we can say, so risk is any unwanted event, okay, which can arise and which can affect the company in negative way. This is the first way, like anything, any unwanted event, okay, which can affect the company in negative way, that is also called a risk. Sometimes we also say risk is the chance of something happening that will have a negative effect on the achievement of organizational objective, that like these risks or these events may restrict the organization in achieving their objective. So this is also called risk. For example, you may have a risk of non-compliance, right? Maybe you are not following laws and regulation. And what would be the negative effect on the business? Maybe regulatory authorities, they can impose certain fine on you, or maybe they can stop your operations, right? So another risk is what? For example, you may face a risk of exchange rates, like it is kind of financial risk, exchange rate risk. Like for example, if you are dealing with the foreign customers or foreign suppliers, sometimes you have payments or receipts in the foreign currency, right or wrong, but those foreign currencies you need to convert into your local currency because you have to use in your country. Or if you have to make, for example, foreign currency payments, maybe from the local market you will buy foreign currency and then you will make payment. So how exchange rate risk can affect you? Obviously, maybe the day when you are entering into the transaction, when you are buying and selling goods, at that day rate could be different, but at the time of payment or receipts, actual payment and receipts of the foreign currency, rate could be different. Rate means exchange rate, it could be different. This is also a risk. Sometimes you may also have risk of other financial losses. For example, maybe you don't have proper health and safety, you can say, policies within your companies. So due to that, obviously maybe certain employees may face some damages, or maybe certain employees might be, I'm just saying, maybe they may get some injuries, right? And maybe you have to pay compensation for that. So that is also kind of that is also kind of risk. For example, maybe harm to the employees, this I have already explained. Maybe sometime there might be a risk to the reputation of the organization also. For example, if you are selling faulty products, let's say by mistake you made a faulty product or chemically contaminated product, and you sold it to the customer, and once customer has used this product, maybe he got injured or something like that. So again, it may affect your reputation. So it means what I told you, risk is the chance of something. A risk is the chance of unwanted event that will have a negative effect on the achievement of organizational objective. Now there is a word which we are discussing, risk management. Okay, so what is risk management actually? Risk management in simple words, so we want to protect our companies, our organizations from potential losses. Potential losses means that those losses may arise in future. So to protect an organization from potential losses or from potential threats to its continued operation, like what it means, like risk management means that simply we want to protect our organization, our company from potential losses, for coming losses, upcoming losses, right? So this is called risk management. How we would save our companies, for that obviously we need to make a proper plan. So if you will make a proper plan to manage the risk, that is called risk management. Understood? Now, here we have a very important note, guys. Please remember, when it comes to risk management, so obviously, guys, every organization face different types of risk, different kinds of risk, right? So that is why it is so important for the organization to have risk management plan. Okay, to have risk management plan, right? So in risk management plan, what we will do, that we will see like what we are going to do under risk management. So that I'll explain here. So that is why every organization is facing different types of risk. For example, if you are into the banking sector, so it means you are under highly regulatory environment, right? So there is compliance risk is more severe. For example, if you are maybe under manufacturing business, you may have a different types of risk. Maybe if you are into the service business, you may have a different types of risk, right or wrong? So simply, so we cannot fit one size solution or one solution to all types of risk. No, because every risk is different. Every risk we need to deal in different way, right? So that is why we need a proper risk management, right? Now here the first thing which we are going to talk about after the definition of risk. So we are going to discuss about first types of risk, like what types of risk we are facing. So actually, guys, the first word which I want to explain, that is called hazard risks. Hazard risk. What is hazard risk? Simply first understand what is hazard risk. So hazard risk include risks that present a high level of threat to life, health, or property. Like any risk which you are facing at high level, even this threat is relevant to the life, health, or property. So that is called hazard risk. Why it is hazard? Because these risks are insurable risks. These risks are insurable risks. That is why hazard risks are also called insurable risk, because we can get insurance for that. For example, you can get insurance for life, health, and property. Understood, guys? So then we have here what? So please remember here what types of hazard risks are there. For example, you may have a risk of natural disasters. You may have risk of death, for example, of senior officers, maybe sabotage to the business system, maybe impairment of physical assets, terrorism. All these are called hazard risks. So in simple words, hazard risks are insurable risks, and usually these risks are relevant to the life, health, or property. Now we have a second type of risk, which is called financial risk. Usually, guys, financial risks are what? Financial risks refer to risks that are directly related to the money. Like it is simply, it is going to affect your monetary values. Okay. So that is called financial risk. But the point is that, so please point is that, so for example, this is also financial risk. Like maybe you have a risk that your cost will increase or your revenue will decrease because it is going to affect your money. So this is also called a financial risk. Now, what are the examples of financial risk? Financial risk may include interest rate risk. We need to understand what does mean by interest rate risk. Financial risk may also include exchange rate risk. It may also include commodity risk. It may also include credit risk. It may also include liquidity risk and market risk. So few I'm going to explain here. For example, I'm going to explain here what does mean by credit risk first. So for example, assume you are into a situation, let's say you are a bank. So you want to lend money to the borrower. You are going to give simply loan to the borrower. So what risk you are facing now? Think. So you are facing that borrower will default, right? He may default and he may not be able to repay your principal amount or your amount of interest, right or wrong? So this is what is called credit default risk. Like you owe some money from someone, right? Or someone owed money to you and you are having risk that maybe you will not get that money back, right? So that is called what? Credit default risk. And usually this risk, this credit default risk, how it is estimated? It is estimated by credit rating agencies. So there are certain agencies are there like Standard and Poor's, Moody's, Fitch, these kind of agencies are there. So they can assess the credit rating of your customers or of a specific company or of a specific investment. So, but the point is credit risk is the part of financial risk, right? Then you have a second risk here. For example, you may have a risk of, for example, uh, For example, liquidity risk. What is liquidity risk? Liquidity risk is the risk that the security cannot be sold on short notice without a loss. So what does mean by security? Security means, say, for example, maybe you have purchased certain bonds or certain stocks of new companies, maybe, or maybe of the risky companies, and now you want to sell those your investments. Maybe you want to sell your bonds or you want to sell your stocks, but maybe you cannot sell it without incurring a loss. That is called liquidity risk. Simply, investment maybe cannot be easily converted into cash, right? So that is called what? Liquidity risk. This is also financial risk because it will also affect you in monetary terms. Then what we have here another risk that is called interest rate risk, which is also called maturity risk. Please remember here, what does mean by interest rate risk? Actually, interest rate risk mean to say your investment and investment security. For example, bonds. Let's assume you have purchased a bonds of the company. So the market value of the bonds will fluctuate, okay, between the time it was issued and its maturity date. So let me explain this point, what it means. For example, this is the bond, and let's assume the bond carries 10% interest rate. Okay, and this bond is for example, 10 years. And today the market value of the bond, for example, is $100. I'm just assuming. Now this bond carries the fixed interest rate, 10%. Okay, so I hope so you know the bonds, right? So now please remember here. Now see what happened in the market. For example, if government will change the rate, let's assume. For example, government will change the rate, okay, of interest, for example, to 15%. But this bond carries fixed interest rate. Now people always, because investors, they always want more return, right? What they will do, they will sell these bonds, and they will invest into this option. Reason is because this option offers you 15% of return. So it means when you will sell this bond, not only you, maybe everyone will sell, every investor will sell these bonds because this bond offers you only 10%. So everyone want to earn more interest. So if everyone will sell, obviously supply of bond will increase. So due to that, market value will decrease. On other hand, for example, if in the market rate of interest is, for example, 5%, but this bond offers what? 10%. Now what will happen? For example, if rate in the market has changed to 5%, but this bond offers 10%, what people will do? Maybe they will withdraw money from this option. They will start investment into this option. The reason is that because now they can earn 10% interest by investing in the bonds. Now everyone will do this. When everyone will buy these bonds, obviously demand will increase. Due to that, market value will go up. So this is what it means, interest rate risk. So interest rate risk is what? So interest rate risk is the risk that investment security will fluctuate in value between the time it was issued and its maturity date. Why it is, from the time of issue to its maturity date? Because, for example, if maturity period is 10 years, it means so there are 10 years in which interest rate can go up or go down. And so there are more chances that your investment in bonds or your security will fluctuate in value. So that is why this is very famous statement. The longer the time until maturity. For example, on one side, one bond is having only 2 years life. On the other side, one bond is having 10 years life. It means this 10-year bonds with 10 years life is having more chance to fluctuate in value because it is a duration of 10 years, right? And here you have a duration of 2 years. So it has less chances that there will be more fluctuations in 2 years time, right? So that is why the statement is very famous. The longer the time until maturity, the greater the degree of maturity risk. Like if the maturity period will increase, obviously this interest rate risk will increase. Right or wrong? Now, guys, please here we have another risk. It's also type of, these all are the types of financial risk. We have here exchange rate risk also. Exchange rate risk, I already told you, it is the risk of loss, okay, because of fluctuations in the relative value of a foreign currency. Like, for example, if you're living in India, for example, today you bought some goods from USA and rate is $1 to 70 rupees today, okay? So you bought goods for $1,000. It means if you will convert into rupees, it is going to be 70,000. It means as per today rate, you have to pay 70,000 Pak rupees. What if you will make payment after 3 months? After 3 months, the rate could be 80 rupees, $1, 80 rupees. It means now you have to pay 80,000. So see how much extra you are paying, 10,000. So this is what is called your exchange rate risk. So what is exchange rate risk? It is the risk of loss because of fluctuation in the relative value of the foreign currencies in which the investment is payable. Understood? So this is the second risk. Now I'm going to talk about another type of risk that is called what? Business risk. Okay. Please remember, because there could be a many questions, various questions in which you have to decide: is it a business risk, is it a financial risk, is it a maybe hazard risk, right? So please remember, in financial risk, I use these words. Which words I used? I said interest rate risk, exchange rate risk, commodity risk. Even commodity can also fluctuate in value. Credit risk, liquidity risk, market risk. These risks are example of financial risk. But when it comes to the operational risk, so I'm explaining first of all business risk. Okay, so business risk is what? Please, this is the third risk I'm going to explain. Business risk. Okay, first I explained hazards, then I told you financial risk and business risk now. Okay, so what is business risk? Business risk is the risk that the company will have lower than anticipated profit, or the company may incur a loss. For example, I was projecting that I will get a profit of 100,000 in the next year, but risk is that I may get a profit of less than 100,000. It means this I will have a profit lower than anticipated, or maybe I may have a loss also. So it means I may incur a loss as well. So this is called what? A business risk. So how you will define the business risk? It is the risk that a company will have lower than anticipated profit or will incur a loss. Understood? Now, please remember here. So now business risk is very big term, right? So business risk, anything, you can say this way also, anything that threatens a company, like it is a threat to the company, or it is the threat to the company's ability to achieve its financial goal, right? What is goal? Maybe I was expecting I will earn a profit of 100,000, but I may earn profit less than 100,000, or I may incur a loss, right? So anything that threatens a company's ability to achieve its financial goal is considered a business risk. Understood? Business risk is broader term actually. So sometimes see, business risk can arise also from leadership also. Right or wrong? For example, if your CEO will take a wrong decision, right or wrong, it can create a risk for the business as well. Right? So now we are going to talk about here business risk. As I told you, it can arise through the leadership also, or management also, right? Sometimes management or leadership creates a situations where a business may be exposed to a greater degree of risk, right? Maybe sometimes leadership will take wrong decisions which can lower your profits, or which can push you into the losses. Okay, so this is now business risk definition. Actually, this is the exact definition, this statement. Now we are going to talk about types of business risk, please. So we have a different types of business risk actually. Okay, so let's understand first type of business risk. First type of business risk is called strategic risk. Strategic risk. Okay, strategic risk is what? So guys, please remember here, strategic risk mean to say it is the risk when a business does not operate according to its business model or according to its plan. Like for example, when you are not doing your business as per your strategy, right? That is called strategic risk. For example, maybe let's assume customer demand has changed in the market. Let's assume, right? But you are not producing the products which are required by customer. It means you are not working maybe as per business model or as per plan, right? So this is also called strategic risk. Okay, so when a company does not operate according to its business model, its strategy become obviously less effective over time, and company may struggle obviously to reach its defined goals. So strategic risk means it is a high level risk, right? Or maybe you are selecting wrong products to manufacture. Maybe you are not predicting the customer demand of the product, which kind of specification customers want. So all these are called strategic risk. Now guys, compliance risk is what? Compliance risk simply is the risk that you may not follow the laws and regulation, right? This is also business risk. Okay, types of business risk, compliance risk. So compliance, for example, maybe there are new employment laws and regulation, but as a company, you may not follow that. So there could be a fine on you, right? It is compliance risk. Maybe new accounting standards have been, maybe the new accounting standard or standards have been issued by the regulatory authority. You are not following, that is also compliance risk, because you are not following the laws and regulation, even it is relevant to the accounting, or it is relevant to health and safety. Maybe it is relevant to the employments. It is if it is relevant to the environments. All these are called compliance risks. So that this compliance risk, the second form of the business risk. Okay, sometimes known as, it is also known as regulatory risk, because you may not follow laws and regulations, right or wrong. And this risk is very high, usually in those sectors which are that are highly regulated, for example banking sector, right? So that is highly regulated, right? So this risk is more in the banking sector as compared to maybe to the, for example, service industry. And the compliance risk is also very important for audit firms even, right or wrong. You have to follow laws and regulation, accounting standards, auditing standards, right? So this is what is called compliance risk. This is the second type of business risk. Then third type of the business risk is called what? Operational risk. Third type is called what? Operational risk. What is operational risk? Please remember here, operational risks are related to the enterprise ongoing everyday operation. So it means these risks are relevant to day-to-day operation, right? So for example, and the operational risk may arise due to the failure of internal processes, or due to the failure of people, or due to the failure of system. These three keywords are important. Like that, this risk will arise due to the failure of internal processes, people, or system. So that is called what? Operational risk. For example, you are not hiring appropriate people with the right skills. So again, so this can create operational risk. Due to their negligences, business can face certain losses. Or for example, you are not following proper system, or due to your system failure, right? So you may face a risk. Or maybe due to internal processes, maybe production process, ineffective production process, ineffective sale process, or maybe ineffective payment process. So you may face certain risk, right? Operational risk will always arise. These are three keywords: due to failure of internal processes, or failure of people, or failure of system. So here example is quoted, for example, in 2012, HSB bank is there, right? So it is a multinational bank, right? So HSB faced a high degree of operational risk. Why? Because they are saying, and as a result incurred a large fine from the US Department of Justice. Actually, maybe there was certain laws and regulation, okay, relevant to the money laundering operations, but HSBC, maybe they were not, or they were unable to stop money laundering in Mexico, actually. Okay, it means it's a failure of internal processes, you can say. Or maybe it is a failure of people also. Maybe those people who were responsible for that, they were not working. So that is why HSB, okay, the US Department of Justice, they imposed a huge amount of fine on HSB. Right? This is what is operational risk. Then here we have here reputational risk. This is what is the fourth type of business risk. Because look at here, guys, in business risk, I used four keywords. I said strategic risk is the business risk. It can arise due to failure of strategy. Compliance risk, maybe you are not following laws and regulation. This is the second type of business risk. Operational risk, which the risk which may arise due to failure of internal processes, people, and system. And then we have a reputational risk, fourth one, which is a part of business risk. Reputational risk, what? Obviously, any risk, maybe you're wrong decision making, right? For example, if I continue with the same example which I told you about HSBC. So what happened? The reputation of HSBC flattered in the aftermath of the fine. It was leaped from the poor anti-money laundering practices. Actually, see, when anyone will come to know that HSBC is involved or failed to stop money laundering, or maybe they are involved in money laundering, obviously it will destroy your reputation, right or wrong? So reputation means it is going to affect your goodwill, it is going to affect your brand name, okay, it is going to ruin your brand name, right? So this is what is called, what is reputational risk, and it can arise due to anything, maybe, right? So sometime maybe you may, due to this reputational risk, you may lose customers, or maybe you may lose brand loyalty of the customers, right? So because sometimes customers are brand conscious, but if you will do zigzag things, maybe they can stop buying your product, right? This is what is called reputational risk. Now, guys, we have here one more point which we are going to discuss now. Now we are going to discuss key steps in the risk management process. Actually, we are talking about risk management process. Risk management process means it is, you can say, complete a process. Process means it is, there are certain stages to manage the risk. You know why risk management is important? I told you already. Risk management is important to protect the organization from potential losses, right or wrong. And whenever you are trying to do risk management, so usually we follow these steps. Okay, so first step is what? Identification of context. Second step is what? We have to identify the risk. Third step is what? We have to assess the risk and prioritize it. Okay, prioritize means which risk we need to manage first. I'll explain these steps, by the way. Okay, and this risk assessment and prioritization is also called risk analysis. And the fourth step is what? After the prioritization of risk, we need to set risk response. We need to take certain actions to mitigate those risks, right? And the fifth step is risk monitoring. We also need to monitor how your risk responses were and how effective they are, right? So this is what we are going to do, these steps actually in the risk management. Please remember here, being a management, you have to focus on risk at all level. Or at all level mean to say you should not focus only, risk management should not be only in one specific department. A risk management should not be in one specific business unit or in one specific factory. You should manage the risk at all level, even at operational level, even at strategic level, right? Or even at departmental level, even at a unit level or factory level, right? And obviously, guys, so please, this is what we are going to discuss now. First step I'm going to explain under risk management, which was what? Identification of context. So here I'll go through now different concepts. I hope so you are understanding, guys. Step number one is what? We will identify the context. Actually, what I believe context mean to say, being a risk manager or being a, for example, if you're the head of risk management department, so the first thing you have to, before actually risk identification, actually, so it is a precondition of the risk identification. Precondition means say, before identification of risk, you have to think first in which area or in which context you are trying to manage the risk. For example, context means maybe you are looking for the risk in laws and regulations area. Maybe you are looking for the risk in certain capital projects, in certain investments. Maybe you are looking for the risk in specific business process, or maybe you are looking for the risk relevant to technology only, or maybe you are looking for the risk market risk, for example, interest rate, foreign exchange rate, or equity investment, or maybe you are looking for the risk as organization as a whole. So this is what is called context. Usually I told you risk management should be there at all level, but in the identification of context, for example, maybe I'm going to start a new project and I just want to see which kind of risks are there in this project. So I have to decide context first. Context means the area or the context within which risk should be managed. Area, I would say in simple words, right? Like you have to decide the specific area in which you want to identify the risk. This is what is called identification of context. This is the precondition to risk identification. Understood? So then once it is area is decided, identification of context is decided, then guys, second thing is what is important. That is step number two, that is risk identification. So guys, please remember there are, I'm just going to explain first here. So whenever you are identifying risk, obviously, if you are identifying risk at the organizational level, so you should then look into each department, in each business unit, in each division, throughout the entity, you have to look then, right? So in risk identification means that you are going to highlight the risk. You are going to simply identify the risk. Okay. Highlight or identify the risk, right? So please remember here, sometime risk, I'll tell you how to identify, don't worry. Okay, what methods we can use this, I can talk. Okay. So please remember here, sometimes we face risk due to external factors. Sometimes we face risk from internal factors. External factors are what? For example, external factors at the entity level include what? Technological changes. Right or wrong? Maybe if technology will change outside, obviously change in technology is the external factor, so it may affect your business. So change in customer wants, so customers are external also, right? So if they are changing their needs or specifications, they want different product with different specifications, so this is also external risk factor. Okay, so then what are internal risk factor? For example, interruptions in automated system. Okay, for example, this is internal risk factor, right or wrong? Maybe quality of personnel hire. Maybe you are not hiring appropriate people with the right skills, right? With the right skill set. So this is also internal risk factor because it is coming due to your failure of your process or system. And maybe the level of training provided, maybe you are not providing enough training to the staff to run your operations. Obviously then they will make blunders or mistakes, right? So please remember, whenever you are identifying the risk, so we always look into the past events also, that what happened in the past. So that information can also be used to identify risk. And we also need to consider future possibilities as well. So please remember, whenever you are trying to identify risk, you have to look back into your past also. You have to look into future also. So which kind of risk you have faced in the past. So those risks might present today also. And maybe which kind of risk you may face in the future. For example, let's assume UAE, they have introduced corporation tax. So what risk you are facing, maybe you may not follow corporation tax laws and regulation. So that is future possibility, right? So by the way, it is already implemented right now in the UAE. But I'm telling you, so whenever you are trying to identify risk, you have to look back into your past. You have to look what were the events there, which kind of events were there. Maybe those events might be present also, right? And what may happen in the future as well. So please remember which kind of methods we can use in the risk management. First method is event inventories. In past, inventories means you have some information. So certain events are common to particular industries, right or wrong. For example, uh, I'm just giving example, maybe compliance risk is common for all banking sector, right? So exchange rate risk, maybe it may also involve, it may be the common for all banking sectors, right? Because they are sometimes dealing with the foreign investments also, right? So please remember, event inventory means maybe in the past you faced certain risk and you have recorded those risks in certain software, right? Or you have recorded in certain place. So please remember here, so that event first we should look past events. Inventories of past risks we should look first, right? Maybe and then check, maybe those risks might present today also. This is the first way, right? It could be the starting point for event or risk identification. So this is called event inventories. Then what we have here, second thing is what? There is a second way to identify the risk, that is called what? Questionnaires and surveys. Sometimes guys, what you may prepare a questionnaires, you may send to the different departments. I hope so you know the questionnaire, right? And now each departmental manager, he may fill that questionnaire, right? And send back to you. And that can also be used to identify the potential events or the risk. Then third method which we can use, that is facilitated workshops. We can conduct certain workshops, or we can conduct certain interviews of a key personnel, key people, right? And that can also help you to identify the risk. Obviously, once you will have a conversation with the different departmental managers through workshops or interviews, obviously, it may help you to identify the risk. Then what we have, process flow analysis. Process flow, for example, you are analyzing how we are making sales. Okay, what process is in place? For example, are we assessing? Are we receiving proper customer orders and we are issuing sales order properly? Are we assessing the credit worthiness of the customer? Right, we have to ask these kind of questions. Who is responsible for packing of the goods? Who is responsible for shipping of the goods? Who is responsible for creation of invoice? Who is responsible to send the invoice to the customer? Who is chasing for the payments? So you have to analyze that process, right? And maybe if you will analyze that process which is already in place, it may help you to identify the gaps and the risk in that process. That is what is called process flow analysis. Understood? These are the methods which we can use. Sometimes, guys, we can also use other methods also to identify risk. Like one method is called what? Brainstorming. What is the brainstorming? It is by the way explained here because it was just word is written. Brainstorming. Brainstorming what? Actually, it is a group problem solving method. For example, here you will call a couple of people as a group, right or wrong, and you will ask a question of them, and whatever ideas or solution will come in their mind, so they can give you that, they can suggest that solution, right or wrong, and maybe you may get some information from there also, right or wrong. So Brainstorming is a group problem solving method that involves the spontaneous contribution of creative ideas and solutions. This technique requires intensive freewheeling discussion in which every member of the group is encouraged to think aloud and suggest as many ideas as possible based on their diverse knowledge. This is brainstorming. And other method we can also use to identify risk. That is what is like we may do SWOT analysis. I hope so you have idea about SWOT analysis. You should look the strength and weaknesses within your business. You should look opportunities and threat outside of your business. So this can also help you to identify risk, right? And then sometimes you can also do what if analysis, scenario analysis, like what if this will change? For example, what if the material will be shortage? What will be the effect on our production? For example, what if let's you material cost will increase? What will be the effect on cost of the product? So scenario analysis or what if analysis can also help you to identify the risk, right? So these are different methods are there. So guys, I'm just going back one time. I told you first step was to identify the context of the identification of context, right? And second step is identification. I told you it is the area which we have to decide. And second step is the risk identification. And for risk identification, I told you different risk identification methods are there. And then we have a third step, which is called what? Risk assessment. This is really important. Please, guys, remember there are few couple of words which I want to explain. So please remember risk assessment. Actually, whenever you are assessing risk, so what you are checking? You are checking actually uh, two things mainly of that risk. What? You are checking like how much chances are there that this risk will arise. Chances means a probability. Chances of occurrence. Okay. Chances of occurrence. It is also called likelihood. So whenever you assess risk for each identified risk, whatever is you have identified, so you have to check what is the likelihood, probability, or chances of occurrence of that risk. And second thing, you need to know what is the impact of that risk. What could be the impact of that risk, right? Impact means the severity, how severe it is. Now, please remember also, this is the first thing which you should remember under risk assessment. So for each identified risk, we actually need to check two things first, like how many chances are there, what is the likelihood, what is the probability. Okay, so then we have to see what is the impact, how severe it is, right or wrong. And please remember, sometimes risk assessment could be formal, or it could be informal also, right or wrong. So these keywords you should remember. Formal means that you have a proper system to assess the risk. Informal means that you don't have a proper system, but just you are using sometimes your judgments like that, right? So what risk assessment could be formal or informal. And third thing which you need to remember, risk assessment may be qualitative or quantitative. Now, these two words are important. Okay, so mostly when we apply certain mathematical equations, certain quantitative methods to identify the to assess the risk, that is quantitative. Sometimes when we use just judgment, these kind of thing, that is qualitative. So I'm just going to explain this word in more detail now, because most of the time we are confused. Is it a qualitative assessment or quantitative assessment? Usually when digits are involved, we say it is quantitative. When digits are not involved in risk assessment, we say qualitative, but the proper difference I'm going to explain now. Please remember, so risk analysis. So risk analysis means that you are doing risk assessment. As I told you, risk assessment is also called risk analysis, right? So please remember, so risk can be analyzed in qualitative way and in quantitative way. In qualitative way, what? For example, we may have a risk register. It is kind of a document actually. Okay, we can use that, or maybe we can use the expert judgment also. This is qualitative. Maybe we can use probability impact matrix also. It's just the name I'm telling you, right? So that is qualitative risk assessment. For example, if I'm saying that, for example, let me just give you example. This is also kind of a qualitative risk assessment. For example, if I would say, uh, I'm assessing like risk, that this is likelihood, I'm assessing likelihood. Likelihood means the chances. I'm saying that chances are what? High, medium, low, and impact I'm measuring this way. Impact I'm measuring here, for example, impact could be what? Impact could be a critical, for example, major, minor, right or no? So for example, I'm saying that risk A falls here. Here means to say it is critical, it is medium. Chances are medium. Let's assume that this risk will arise, but impact is critical. Maybe risk B, I'm saying it is here. Chances are high and impact is major. So if I'm using these kind of words, this is called actually qualitative. Usually digits are not involved here, right? So that is what qualitative risk assessment. So we can use this, even we can use experts judgment also, is qualitative. Now in quantitative, I'll explain more difference, don't worry. In quantitative risk analysis, you are trying to quantify, to find out the amounts of the risk. Here digits will be involved usually. So here we can use these methods to quantify a risk. We can use sensitivity analysis. Okay. Sensitivity analysis is kind of analysis. Actually, I'm not going to explain what it is. So sensitive means say if your variables, whatever variables, factors are there in risk assessment, what if one factors will change? What will be the effect on the outcome, right? So this is sensitivity analysis. We can use decision tree analysis, scenario analysis, also what if analysis. Okay. Then hypercube simulation we can use, Monte Carlo simulation. These are actually simulations. Models are there which we can use to assess the risk. So this is called what? Quantitative risk assessment. Now these are just examples of qualitative and of quantitative. Now the point is, what are the key difference between qualitative risk analysis and quantitative? So here we go. Now I'm going to explain, you will get better idea. So what's the difference between qualitative risk analysis and quantitative? Number one, qualitative risk assessment is subjective. Subjective means based on your judgment on. It is a subjective approach, but quantitative, it is the objective approach. Objective means say it is, this data is more verified data. Okay, and we are using certain statistical tool to analyze the risk, but it is a subjective approach. Primary objective is to identify severity of risk. Here we are focusing on how severe it is, but it is objective approach that uses verified data and statistical tool to analyze risk and impact. Right? So keyword here, it is subjective, it is objective. Right? Second is what? How it is, how it is, how it is, how is it performed? Number one. In qualitative analysis, we ranks the risk. You know, ranking, we do the risk on 0 to 1 scale. For example, it is, for example, this risk is, I'm just assuming we are ranking it is 0. Maybe it is at 0 0.1, 0 0.2, 0.3 level, which level? So 0 to 1 scale we rank. But here, consider risk closer to 1 to calculate risk. Like here under quantitative, we pick only important risk. More important, which are closer to 1. Okay, not closer to 0. Closer to 1, which are at this place. Those risks we will identify and we will calculate the risk then. Then what it does. So here under qualitative approach, assess likeliness of risk to inform team about which is to be addressed first. Like here just we are telling like which risk you have to manage first, which risk is having high chances. But here under quantitative, as I told you, digits are involved. So we use numerical calculations to determine risk and its impact. Okay, here our focus is on likeliness. Right, here our focus is on numerical value. And here complexity, which is more complex. Obviously, this is more complex as no tools to assist. We are not using any statistical tools, but this is less complex as tools are available to assist us in decision making. Then what? The time consuming. Obviously, it is more time consuming because we are using subjective judgments, etc. And this is less time consuming because we have certain simulations which can help us to do this risk assessment. When to perform? Obviously, at start of every new project we perform. And here quantitative assessment, when there is a loads of data on the risk, when you have a, you know, we have already available data on risk, then we perform it. And we perform risk, we are trying to quantify important risk, right? But this we do at the start of every new project. Ease of use. It is easy to use as no calculation is involved, and not easy as it involves number and calculation and statistical too. Then what next? Suitability. It is suitable to all kind of projects. It is suitable for complex projects. Then what? Volume of risk. Consider all the risk, but under quantitative assessment, considered important risk, as I told you, marked by qualitative risk assessment. Like for example, if you first will identify all risks here, and then see which are important. Then those risks you will try to quantify. Understood? It means in qualitative, we focus on all risks, but in quantitative, we focus only on the important risks. This is what is the difference. And the above, which I told you, I showed you here, those are the models which we can use actually to quantify or to uh, qualitative for the qualitative analysis and for the quantitative analysis. Understood, guys? I hope so it is clear. Now, this is the third stage, guys. Once third stage is passed, obviously, based on your qualitative and quantitative risk analysis, then you will also do prioritization. Okay, prioritization means to say you have to rank the risk, which risk should be managed first, which risk should be managed second, which risk is managed third. It is always based on your risk analysis. It is always based on your risk, I would say, assessment. Now, guys, here, please remember here, there is a one more definition. I'm telling you, sometimes they ask this definition in your exam question. They may ask you what is unexpected loss or maximum possible loss. So please remember here how you will define it. So this is a definition of unexpected loss and maximum possible loss. Actually, it is the amount of potential loss. Potential loss means the loss which may arise in future. It is the amount of potential loss that exceeds the expected amount. For example, expected amount, let's assume potential loss. We are expecting that, for example, loss will be 10,000, but this is our 10,000. We are just expecting, for example. Okay. This is the expected amount. Expected amount. I hope so you have the idea about expected values, guys. Okay. That is the expected amount. For example, if actual loss will be 11,000. So how much amount exceeds 1,000? So this 1,000 is called unexpected loss or maximum possible loss. It is the amount of potential loss that exceeds the expected amount or expected value. So this is just a guy's example here. We have one example for risk assessment. For example, we have a risk of a system penetration by hackers. This is risk. So what are chances? For example, if there will be a minor penetration, so let's assume you may have a loss of 1 million. If there is unauthorized viewing of internal database, you may lose $50,000. If this third risk is what? Unauthorized alteration in the internal database. Like for example, they may just tease you, they may just view your data, and they may change your data. So then you have a loss of, for example, 2,000 million, let's assume. So then this is what is the impact actually. Impact. What is impact? And then you have to check likelihood for each risk. For example, for first risk chance is 95%, for second risk chance is 35%, for third risk chance is 1%. If you will multiply amounts with the probabilities, so this is called expected loss. This is called what? Expected loss. Okay. So expected loss is how you will calculate. And if you will add, for example, all, I'm just assuming here. Okay, this is your expected loss. Like when you multiply amount of loss with the likelihood, this is called expected loss. If potential loss that exceeds the expected amount, that is called what? Unexpected loss, right? It is unexpected if it exceeds the expected amount. Now here, guys, it is just a reading, just for your understanding here. So they are saying that the company considers it almost inevitable that minor penetration of its system will take place. However, the expected immunity loss is sustainable because in minor system, if there's a minor penetration, so even chances are high, but loss value is only 950,000. By contrast, other two events are much less likely. For other two events, chances are less, but would have disastrous impact on the firm. So it means these must be your priority, right, to manage it. Right or wrong? This is what they are saying. So please, you have to just go through this example, guys. It is on your screen now. Now we are moving down to the step number 4. Step number 4 is what we are, because step number 1 was identification of context. Step number 2 was identification of risk. And step number 3 is about risk analysis, which is risk assessment and prioritization. And now step 4 is about formulation of risk response. Risk response means say what? Simply, guys, this is important. ERM committee, the word they are using. ERM is Enterprise Risk Management Committee. So there is the risk committee actually in our governance system. Because in governance, if you remember corporate governance from part 1 of your exam. So obviously in the governance structure, we have a certain committees, audit committees there. risk committee is there, compensation committee is there. There could be many other committees also, but these three committees are compulsory as per US corporate governance, right? So they're saying ERM committee means a risk committee proposes adequate response strategy. Actually, they propose like which strategy we should follow for each risk. So usually, okay, we have these strategies to mitigate the risk. Please remember, maybe we cannot apply this strategy to uh, eliminate this risk. No, so risk management means that we have to actually mitigate the risk. We have to reduce the risk to an acceptable level, right? That is what is called risk responses. This is the objective of risk response, to reduce the risk to an acceptable level. And usually, who proposes adequate risk response or adequate risk strategy? Risk committee. So here we go. We have the first strategy. I'm just going to tell you here. First strategy is called risk avoidance. This is the first strategy. Risk avoidance means what? Ends the activity from which the risk arises. Simply, risk avoidance means you do not want to take a risk. For example, if I tell you invest in the stocks and you may have a loss of 10,000 or profit of 10,000, you will think, should we take this risk? And you're thinking, no, you are not ready to take the risk of loss of 10,000. You are saying, sorry, I don't want to invest. This is called avoidance. Simply, you are going to cease that action. You are going to cease that activity where you are facing risk. For example, as example, it's written here. For instance, the risk of having a pipeline sabotaged. Maybe you have a gas pipeline or whatever kind of thing. Maybe you have a risk of sabotage, like someone can destroy your pipeline, and you have that pipeline in unstable region, maybe in unstable country where terrorist attacks are there. So how you can avoid that risk? Simply, you can sell that pipeline to avoid that risk. This is what is called risk avoidance strategy. And mostly risk averse people who do not want to take risk, those people are called risk averse. So they follow this strategy, risk avoidance. Then we have a guys, the risk retention. Retention means, please remember here, simply here you are going to accept the risk. Let me just give you example here. It is also called self-insurance. Please remember here what it means. So it means in the risk retention strategy, first let me go to the example. For example, I'm asking you to invest in the stock of ABC company, and you have a lifetime saving of $100,000 with you. And I'm asking you to invest $100,000 into the stock of A company, company A. But you are thinking now, if you will invest in the company A, you may have a loss on entire investment, right? You may lose the money. So now, but you are ready to invest in company A. But what is your strategy? You're thinking that no, I don't want to invest entire amount in the company A. I want diversification. Some money I will invest in company A, some I will invest in company B, some I will invest in company C. Because if you will have a loss in company A, you may have a profit on company B and C. Right or wrong, a loss on one side can be compensated with the profit on other side. So it means here what you are doing, you are accepting the risk. Plus you are making your own strategy to reduce it. You are not engaging third parties. You are not getting insurance for that. So risk retention means you are accepting the risk, right or wrong. Plus you are taking certain actions to mitigate it. Like you are not investing whole amount in company here. You are diversifying your investment. That is called risk retention. So here acceptance, plus you are reducing the risk, but by making your own strategies. Then we have a risk reduction. See, what's the difference here? Sorry, here I made some small mistake. Under risk retention, you accept the risk blindly actually. Blindly means that you do not have a proper strategy to reduce it. So this is risk retention actually. Avoidance means to say, simply avoidance means that you are avoiding risk. You are seizing that action. Retention, sorry. Risk retention means that you are accepting the risk, but you do not have any strategy to reduce it. That is risk acceptance. Okay. Now I'm telling you risk reduction. In risk reduction, the example which I quoted there for investment, that is actually risk reduction. Risk reduction means what? You are going to accept the risk, plus you are going to take certain internal actions to mitigate that risk. As I gave you example, For example, if you are investing in company A, so you are not investing whole amount in company A. You are diversifying your investment, because loss on one thing can be netted off with the gain on other thing. That is risk reduction or risk mitigation actually. Risk, now I'm repeating one more time because don't be confused. Risk avoidance means simply you are going to seize that action. Risk reduction means like it's like you are blindly accepting the risk and you are thinking, let's see what will happen. But in risk reduction, you are not blindly accepting the risk. You are accepting the risk, but you are making some internal strategy to mitigate it. Right? But risk sharing is what? Yes, you are accepting the risk and you are mitigating also. But how? Because you are transferring this risk on the shoulder of others. But in risk reduction, you are not transferring in the shoulder of others. But in risk sharing, so you are accepting the risk, but you are trying to mitigate it by engaging third parties also, outside parties also to mitigate it. For example, best example is insurance. So if you will purchase the insurance policy, obviously, okay. So or maybe if you are doing hedgings of your financial losses through the financial instruments like options, futures, these kind of things. Okay, if you are trying to manage your financial risk or risk of exchange rate through the hedging or by using options, futures, contract, these kind of things, it means it is called risk sharing. Risk sharing means it transfers some loss potential to the other party. So it is risk sharing is also called risk transfer. Risk sharing is also called risk transfer. And risk reduction is also called risk mitigation. And risk retention is also called self-insurance. So there is word is hidden. So it is called what? Self-insurance also. Okay, guys. So these are strategies, and then we have one more strategy that is called what? Risk exploitation. And usually this strategy is followed by gamblers. You know, gamblers, they always look for high risk. They know if they will take high risk, it may give high return also. Okay, so actually that is risk exploitation. Like, there is high risk, but if you will take that risk, you may get high return also. So that is called risk exploitation. So risk exploitation is the deliberate courting of risk in order to pursue a high return on investments. Understood? So that is what is called risk exploitation. So like you are taking high risk with the tension of high return. That is risk exploitation. So these are strategies, and because for each strategies you may have, as I told you, under risk management, you cannot follow one strategy for all types of risk. Maybe you have to manage each risk by adopting different strategies, and risk committee will proposes these strategies. Understood? Now we have here what? Usually this is how we decide. This is also called frequency-severity matrix. Usually this is how we decide risk responses. Okay, risk responses, like should we follow risk retention, risk sharing, risk reduction, or risk avoidance? What we should do. So look at here. First, we'll check your frequency. Frequency means how frequent it is. Like maybe frequency is high or low. You can say it is chances. Or for example, severity, the impact of risk. Please remember here, impact could be low and high also. If any risk which is less frequent and less severe, for that, which strategy we can follow? We can follow risk retention. What was risk retention? You are accepting risk, but you do not have any even internal or external strategy to reduce it. It is like just blindly acceptance of risk. But if your frequency is high, but severity is low, you can go for risk reduction also or risk retention, any one strategy you can follow. Okay, then if your again if your frequency is low but severity is high, so you may go for risk sharing. Like risk sharing means a risk transfer, means say insurance. Or if, for example, frequency is high, severity is high, so then best strategy is what? Risk avoidance. So please try to just see this severity matrix, how we decide risk strategies, risk management strategies. Then guys, we have a fifth stage after risk responses that is called monitoring. Okay, risk monitoring or monitor risk responses. This is the fifth stage. Like obviously guys, once risks are identified, risks are assessed, you have implemented the risk responses, right? And then you need to know the outcome of your responses, like how effective your responses are, right or wrong. So that is called monitoring. So you have to see whatever response you have applied, is there any residual risk after that response, or this risk is completely managed, right? So how monitoring can be done? Usually we can use two types of people to for monitoring purpose. Number one, those people who are closest to the activities. For example, if risk is relevant to finance department, let's assume the risk, there is a exchange rate risk. Obviously, it should be managed by finance department, right or wrong? So then you can take information from finance manager or from the CFO, okay, about your effectiveness of your risk response. So these are called closest to the activities. Like usually these are managers of an operating unit. For example, if a risk is relevant to the operations, you may ask operational manager. If risk is relevant to compliance, you may ask compliance manager, right? You may ask that you may take the information from them because they are in the best position to monitor the effect of the chosen risk response strategies. Second, we can use that is called what? Audit function. We can also use, guys, audit functions. Audit function means maybe you can bring internal audit department to do the audit of compliance department and see they can produce a report on risk management strategies, like how effective these are, what went wrong, what went well. So they can prepare this report, right? Or which kind of residual risks are there. So they can also help us to monitor. They can also supply important information which is relevant to the risk management. Understood? So these two people's kind of people we can use for monitoring purpose. Those who are closest to the activities, and we can use audit functions. Okay. Now, guys, this was all about risk management process. Now we have just small 2-3 definitions. Then I'll show you a couple of questions, please, just to see the idea. We have here one definition that is called risk appetite. Risk appetite is what? Risk appetite, it is actually the degree of willingness of upper management. Like, for example, maybe upper management, they may take a risk of up to $1 billion, or maybe they may take a risk of only $1 million. That is called what? Risk appetite. It's a willingness of upper management to accept risk. It terms the organization's risk appetite. Okay, obviously, if one organization is having high risk appetite, means they have more willingness of the risk acceptance, like they are willing to take more risk. Obviously, they have different types of strategies. And on the other side, if the management with the mindset which they have less risk appetite, they cannot take huge risk on, they cannot take risk on risk for a huge amount, they can take risk for less amount, then obviously their strategy will be different. Right? So the risk appetite means it's a willingness of upper management to accept the risk. Then we have some residual versus inherent risk. Residual risk means it is the risk of an activity remaining after the effects of any risk response. Like what risk is left after taking or after applying the risk response, whatever risk is left, that is called residual risk. Then we have inherent risk. Inherent risk is the risk of an activity that arises from the activity itself. Like the built-in risk is inherent risk. For example, uranium prospecting is inherently riskier than retailing. Like uranium, you can say extraction is more riskier than trading business, for example, right? Okay, normal retailing business or trading business. So this is what is called inherent risk. Then we have here what? Benefits of risk management. This you should also know. This is general topic again. If you will have a proper risk management, what benefit first you will get? So you may use your resources in efficient way. Right now, obviously, when you are having proper risk management, so you can make a plan how to use your resources, whatever resources you have, even people. Right or wrong? So only after risks are identified, so can resources be directed towards those with the greatest exposure. For example, if risk is relevant to compliance, so you can allocate proper person who is having abilities to manage that risk. That is called efficient use of resources. Then obviously, if you will have a proper risk management, so you will get fewer surprises also. Fewer surprises are. Fewer surprise means every risk is being managed. She will not get surprised. Oh, today there are 5 non-compliance, or today we got a fine from regulatory authorities. So these kind of surprises will stop. Right or wrong? And number 3, what? Reassuring investors. Obviously, those people who are investing in your business, by having proper risk management department within your business, actually you are trying to reassure investors, right? You are trying to give assurity to your investors that your investments are safe, right? So this is what is called the third benefit. Are their money is in the safe hand, right? This is what is called third benefit. So these are usually benefits are there. So this thing I have already explained, guys, as a risk. Then we have here risk mapping. Sometimes they ask, risk mapping is a visual tool. This is the keyword. Like you are visualizing, visual tool for depicting relative risk. The probabilities of identified events can be graphed on one axis and severity of consequences on the other axis. Okay, for example, if I'm saying, as I give you example, how severe it is. For example, as I told you, let's assume this is the probability, means a chance of occurrence, high, medium, low. Okay, and then we have here, for example, severity or impact, for example, critical, major, minor, critical, major, and minor. For example, one risk is here at this point, it means impact is critical, risk probability is medium. So if one risk falls here, it means impact is major and probability is low. So this is what is visualization, that you are visualizing for depicting relevant risk. Okay, guys. So now please, I'm just going to show you one question here. Let's have a look to this question. I would just go through. Actually, you should go through this question, guys, please. So they're saying, guys, for example, they're saying a toothbrush manufacturer has noticed a shift of customer preferences. I told you that is always going to be the part of strategic risk, because change in customer demand is strategic level risk. Maybe you are producing wrong products which are not preferred by the customers. So they're saying a toothbrush manufacturer has noticed shift of customer preference. It's growing in its growing Asian sales market towards an electronic battery operated toothbrush. Like people are shifting from traditional brush to the electronic toothbrush. Okay, then they're saying this shifting of the customer taste best represents what type of risk to the toothbrush manufacturer, like what kind of risk it is. Actually, you can say a strategic risk. Understood? So then we have here, because change in customer always fall under strategic, like change in customer preference always fall under strategic risk. So because financial risk is what? Financial risk means the risk of exchange rate, risk of interest rate, risk of commodity risk, credit risk, liquidity risk. So these are financial risk. Operational risk, I told you, risk related to enterprise ongoing everyday operations, which can arise due to failure, internal process, due to the failure of people, due to the failure of system. Do you remember this definition, right? Okay, that is operational risk, right? Then business, I told you, the company will have lower than anticipated profit or incur a loss. It is more because change in customer demands falls under strategic risk. Okay, then we have here, guys, next question. For example, one technique I told, do you remember I told you unexpected loss definition, like potential loss which exceeds the expected loss, that is called an unexpected loss. So they're saying that one technique for quantitatively assessing the risk faced by organization is to weight the monetary consequences of potential event by its probability. Yeah, we calculate expected loss, right? By taking amounts multiplied by probabilities, it is expected loss. Okay. The amount by which maximum potential loss associated with the event exceeds the weighted amount is called what? Unexpected loss or maximum loss. Do you remember? Unexpected loss, what was the term? Just go back there. Look at the terms. What was the terms there? It was unexpected loss, actually. Because this is calculation, guys. I mean to say theoretical, see, unexpected loss or maximum possible loss. Not only maximum possible loss or unexpected loss. What is the amount of potential loss that exceeds the expected amount? Understood? This is how question will be tested, guys. So you have to first go through your proper definitions, then you have to practice on the question. Okay, guys. So in the next class, we'll talk about 12.2 topic about enterprise risk management. Thank you so much. If you have any question, you can ask.